The S&P 500 is one of the most popular investments that people are constantly talking about in the news. But what exactly is it? And why do most investors recommend it to almost everybody? Let's get into the video. Welcome back to the channel, everybody. My name is Elvan. If you're new here, consider subscribing for more content just like this one. So first things first, what exactly is an index? In finance, an index is basically a group of securities that are put together based on certain criteria. The goal of an index is to track the performance of a particular segment of the market or economy. There are thousands of different types of indexes out there with different criteria. A few examples would be the Dow Jones Industrial Average or the DJ, the Nasdaq Composite Index, and the Russell 2000. And one of the most well-known indexes of all, the S&P 500. Now each index is going to track a different set of securities. For example, the DJIA only includes 30 large publicly traded companies, whereas the Nasdaq Composite Index includes over 4,000 different securities. And then there's the S&P 500, which we'll talk more about in a second. When you invest into an index, what you're actually investing in is a collection of all those securities within that index. So if I wanted to invest in the Nasdaq, I would actually be buying a tiny piece of Apple, Microsoft, Amazon, Google, Intel, and so on. And this is also known as diversification. So now that you understand what an index is, let us talk about the S&P 500. The S&P 500 is an index that tracks the performance of 500 of the largest companies in the U.S. stock market. It represents about 80% of the entire U.S. stock market. This index was created by Standard & Poor's, otherwise known as S&P, which is a subsidiary of the financial giant McGraw-Hill. The index was launched on March 4, 1957. Now there's actually a couple different versions of the S&P 500, but the version most people invest in is called the S&P 500 Index Fund. One of the most popular funds that tracks the S&P 500 is the Vanguard S&P 500 ETF, which has the ticker symbol SPY. According to Vanguard, there are currently 350 million shares of this ETF outstanding, and the market cap is around $383 billion. This means that almost $400 billion worth of investments flow into the SPY ETF in order to track the S&P 500. Now, that is just one fund that tracks the S&P 500. There are hundreds of other funds that you can choose from. Some other popular options include the SPDR's S&P 500 ETF, the iShares Core S&P 500 ETF, and of course the original and most popular S&P 500 Index Fund, which is the one managed by Fidelity. I should mention that even though these are technically known as index funds, when you invest into one of these funds, you're not technically investing in a collection of actual stocks. You're actually investing in shares of the fund itself. So when you buy one share of SPY, you're not buying one share of Apple. Although SPY does hold about 70 shares of Apple, what you're actually buying is a tiny piece of everything that SPY owns, including the 70 shares of Apple. Alright, so we know what the S&P 500 is, and we know how to invest in it. But why do most investors recommend it to pretty much everybody? Well, there's several reasons. First of all, the S&P 500 has historically had very strong returns. According to Encyclopedia, since its creation in 1957, the S&P 500 has had an average annual return of 10.39%. Now it's important to note that past performance does not guarantee future results. However, the S&P 500 has a long history of producing positive returns over time. Keep in mind that there have been some periods of negative returns. For example, between 2007 and 2009, the S&P 500 declined by 57% due to the Great Recession. But over the long term, it has recovered and continued to grow. Another reason why the S&P 500 is so popular is because it is very diversified. As I mentioned earlier, the S&P 500 includes 500 of the largest companies in the U.S. stock market. This means that if one company does poorly, it won't have a major impact on the overall index. For example, if Tesla stock declines by 50%, it won't affect the S&P 500 that much, because Tesla only makes up about 1% of the entire index. On the other hand, if a smaller company does poorly, it won't be included in the S&P 500 to begin with. This is another advantage of the S&P 500. It includes big, stable companies that tend to be less volatile than smaller companies. Of course, the S&P 500 is still subject to volatility due to market conditions and investor sentiment. However, it is generally less volatile than the overall stock market. Next, the S&P 500 is very liquid. This means that it is easy to buy and sell shares of the index. There are millions of shares of the S&P 500 ETFs outstanding, which means that there is a lot of buying and selling activity. This makes it easy to enter or exit a position in the S&P 500. And finally, the S&P 500 is relatively inexpensive to own. Most index funds that track the S&P 500 have very low expense rates, which is a fee that you pay to own the fund. This is because it costs very little to own an index fund compared to other types of investments such as actively managed mutual funds. Actively managed mutual funds try to beat the market by buying and selling different securities. However, They typically don't beat the market, and they charge higher fees. Index funds simply track the market, which is why they are so cheap. In conclusion, the S&P 500 is such a popular investment because it has a long history of strong returns. It is very diversified, liquid, and inexpensive to own. There's really no wonder why it's the most popular investment out there. There are, however, a few potential drawbacks to investing in the S&P 500. First of all, the S&P 500 only includes large companies. This means that it doesn't include small companies, which may be growing faster than large companies. Also, the S&P 500 only includes companies that are headquartered in the United States. This means that it doesn't include companies from other countries, which may be growing faster than U.S. companies. Finally, the S&P 500 is a stock market index, which means that it is subject to market volatility. However, as I mentioned earlier, the S&P 500 is generally less volatile than the overall stock market because it includes large, stable companies. If you want to learn more about investing, check out my Investing for Beginners playlist. And if you enjoyed this video, feel free to leave a like and subscribe to the channel. Thanks for watching.